Welcome to Geopolicy Hub, where we unravel the complexities of global economics and geopolitics. Join us as we navigate through the ever-changing landscape of international relations and financial dynamics. Get ready for insightful analysis and deep dives into the forces shaping our world. Decoupling from China entails reducing the economic ties between China and other nations. This concept gained prominence due to increasing political tensions, particularly between China and Western countries such as the United States and members of the European Union. In this video, we examine the potential impacts of decoupling on the global economy with a focus on trade volumes among China, the United States, and the European Union. We analyze the potential effect on each economy and identify which party might be most affected. Before we continue, we'd appreciate it if you could support our content by clicking the like button. Thank you so much. The United States decoupling from China. The United States and China are major players in the global economy. The U.S. has been a dominant force since the late 19th century, especially after World War II and the collapse of the Soviet Union. It is known for innovation and as an investment destination, though it faces challenges like trade deficits and accusations of currency manipulation. On the other hand, China has seen rapid growth over the past 4 decades, becoming integral to global supply chains and a key trading partner for many countries. Its economy under the Communist Party emphasizes state control, technological self-reliance, and strong state enterprises. Despite economic significance, China's foreign investment development lags behind, highlighting differences between its economy and those with more open markets. Now we have a question for you. What are your thoughts on China's state-controlled economic model compared to more open market economies? Share your opinions in the comments below. Decoupling, particularly between the U.S. and China, would involve a significant reconfiguration of their economic ties. This process would require dismantling complex trade relationships, restructuring supply chains, and seeking alternative economic partners. Geopolitical tensions, national security concerns, and a desire to reduce reliance on a potentially adversarial state are the primary motivations behind decoupling. Now let's examine the trade volume between the U.S. and China in 2022. China was the 3rd largest goods export market and the 6th largest services export market for the United States. Combined goods and services exports to China supported over 1 million American jobs. However, despite record highs in goods exports, the growth rate compared to other top markets was slower due to factors like economic slowdown in China, the Russia-Ukraine conflict, and U.S.-China tensions. In 2023, total U.S. imports from China decreased by 20.3% from the previous year to $427.33 billion through third countries like Mexico before reaching the U.S. This realignment reflects both geopolitical tensions and a strategic move by the U.S. to lessen dependence on China, which has significant implications for both economies. The mutual dependence between the U.S. and China is multifaceted. Trade is a key aspect, with the U.S. relying heavily on Chinese imports while China depends on the U.S. as a major export market. Investment further binds the two nations, with U.S. companies deeply involved in the Chinese market and Chinese investments present across various sectors in the U.S. Global supply chains centered around China also contribute to this interdependence. EU decoupling from China. The EU's trade relationship with China has grown significantly, particularly in sectors such as electronics, where the EU has become heavily reliant on Chinese inputs. This dependency has raised concerns about strategic vulnerabilities and sparked discussions on the need for decoupling for security and economic reasons. However, the EU's approach to decoupling from China differs from that of the US, aiming for a balance between engagement with China and openness to other global partners. Decoupling efforts in the EU are driven by initiatives under Brussels' risk policy, including investment screening, export controls, and industrial policies aimed at bolstering domestic production in sensitive areas like critical infrastructure and technologies essential for the green transition. Yet, the technology cooperation between the EU and China, particularly in digitization and artificial intelligence, (AI), has significant commercial and academic benefits, making a complete decoupling particularly costly for Europe. In 2019, EU trade with China amounted to $999 billion, showing the scale of economic interdependence between the two regions. German investments in China also highlight the depth of this relationship, increasing from 30 billion euros in 2010 to 81 billion euros in 2017. In the first 11 months of 2023, the trade volume between the EU and China reached USD 76.3 billion, with EU exports to China amounting to USD 27.8 billion and imports from China totaling USD 48.5 billion. This represents a significant trade relationship, although there has been a noted decrease in China's exports to the EU by 11% compared to the previous year. The complexity of the EU-China economic ties, coupled with the strategic competition and security concerns, underscores the challenge of decoupling. Despite the growing political challenges between the EU and China, it remains a critical trading partner for Europe, especially for German automotive and pharmaceutical companies. The potential for economic sanctions against China in the event of a military conflict, such as in the Taiwan Strait, could have a disastrous impact on the European economy. The EU is exploring selective decoupling strategies, focusing on reducing strategic dependencies on China while maintaining mutual interdependency in areas that benefit Europe. This includes diversifying imports and exports away from China and building technological and trade partnerships with middle powers like South Korea, Vietnam, Indonesia, Israel, Japan, and India. BRICS and decoupling. As the US and EU navigate the complexities of decoupling from China, the BRICS nations observe closely, poised to recalibrate their own economic strategies. The potential ripple effects on the BRICS could be mitigated through their collective response. Strengthened intra-BRICS trade, collaborative technological development, and unified political stances are avenues through which the BRICS can reduce the adverse impacts of decoupling. For instance, increased trade within the bloc could compensate for the trade vacuum left by reduced Western engagement. Furthermore, as these nations diversify their economic alliances and bolster their regional partnerships, they can create a more balanced and multipolar world economic order. What are the latest developments in decoupling from China in 2024? The United States has seen a shift in its import patterns with a reduction in dependence on China for both critical and non-critical goods. This change is part of a broader trend towards diversifying supply chains away from China. Specifically, the import share of critical goods from China declined from 17.9% in 2017 to 11.1% in 2023, with significant reductions in sectors where the U.S. had the highest dependence, such as communication-related goods and information technology. Despite these efforts, the complexities of global supply chains mean the U.S. might still be indirectly dependent on China through imports from other countries that use Chinese inputs. The U.S. and China's rivalry is intensifying, particularly in high-tech sectors. The U.S. is expected to escalate pressure on China, especially concerning strategic, high-tech industries. This rivalry is fueled by national security concerns and is evident in policies aimed at limiting investments in critical Chinese industries like semiconductors, quantum computing, and artificial intelligence. There's a bipartisan push in the U.S. to impose new tariffs and restrictions aiming to protect national security and domestic industries. In a notable shift, Mexico surpassed China as the U.S. top source of imports in 2023, with Mexican exports to the U.S. totaling $475.894 billion. This change reflects broader efforts to decouple and diversify supply chains influenced by tariffs and geopolitical uncertainties. The trade growth between China and the U.S. has also slowed compared to their trade with the rest of the world, highlighting the impact of geopolitical factors on trade. In short, decoupling from China involving the reduction of economic ties due to political tensions, especially between the U.S., EU, and China, appears more complex than a complete separation. That's all for this video. Don't forget to like, share, and subscribe for more enlightening discussions on global affairs. Stay informed and stay tuned to Geopolicy Hub for your regular dose of geopolitical insights.